So Jaden, why is it getting harder for first homeowners to enter into the market these days?
Well, it could be the fact that interest rates have gone up by 3%, loan repayments have increased by 30 to 40% just over the last year or two. It could be the fact that property prices are at almost all-time highs. Sydney median house price is approaching $1 million. It's insane. You have to spend $1 million to buy your first home.
And it's really crazy to see that the average age of a first homeowner has risen to 36 years old. So today we're going to cover 3 important tips that'll help you if you're looking to get into the market in the first time and really navigate around the challenges that they face as first homeowners. The first that we see a lot of, Jaden, is first homeowners being worried about their future repayments. So what are some tips around here for first homeowners out there that are wanting to enter the market, but their biggest fear is that they've seen so many rate rises, they're really struggling to cope with the cost of living, and on top of that, getting into the market for a mortgage?
I think a lot of it is the fear of the unknown. It can feel just scary. It's being like, well, I don't even want to look at it because it feels like it's going to be too much. So I'd say the quickest tip, the easiest way you can do it, jump onto our website. It's going to be a pretty rough way of doing it. But if you're looking at buying a place with $500,000, for example, if you've got $10,000 in savings, 500 minus 10 is 490. Put in $490,000 into our calculator, put the interest rate at around 6%, so 6%. Go weekly or monthly and see what your payment's going to be. At least gives you a sense of, well, how much difference is it from what I'm paying in my current rent? You might be renting for $500 a week and the repayments are $700 a week. Well, it's extra $200. Do you have that available? If not, this is where you can set up a mock mortgage. So how does that look?
Well, the other thing you can also do is work it out on a 6% rate, work it out on a 7% rate, work it out on an 8% rate. Look worst case and see what that looks like from your repayments. On top of that, let's say the repayments are $1,000 a week. I'm just making up this number, and you're paying $600 a week in rent at the moment. Well, then make the difference out. Bridge that gap of $400 and get used to what that repayment would look like. Give it a test, try it out for 3 months, 6 months, whatever you're comfortable for, because the last thing you want to do is get into a mortgage and not be prepared for the cost. Now, the banks typically will say, hey, Jaden, I'll give you $1 million or 500,000 or whatever it is your maximum capacity will be, but that doesn't really matter what the banks say. It's more important to lend what you're comfortable with rather than going in above your head and then struggling in the future. Jaden, do you have any tips for first homeowners out there? If they are worried about their mortgage, they can do the mock mortgage, they can go on our website, work out the calculations. Is there anything else they should be doing? Should they try and save a bit of a buffer to cover for foreseen circumstances rising, or what is it that they can really do?
I think where possible, you want to have a bit of a buffer there after settlement. So if you can spare some extra cash, try and have 2-3 months of repayments just in extra cash, in extra savings that you can have there. If you don't, then try and make a bit of a buffer, try and over repay. So like Nathan said, if the minimum is $700 a week in repayments, try and make it as $720, $750, just a little bit if you can. Every little bit helps you pay off that loan a little bit quicker. That can all make a difference. The other thing is get your loan to work for you. So if you have a loan, for example, offset, use redraw, understand how that stuff works if your broker hasn't already told you.
And if you are worried about repayments moving upwards in the future, obviously we don't know what's going to happen down the track, but you can also look at fixing in your loan in. So locking it in for any given period, you can usually fix it for 1 to 5 years, gives you plenty of options around the fact that you can get that stability in repayments. You know what you're up for and you know what you're going for. The next tip that we have is having a champagne taste with a beer budget. Jaden, what does this look like? A lot of our first homeowners seem to have very high expectations. They're looking for their forever home, but what tips can you give here?
This is one of my best friends, Sam, lives on the Gold Coast at the moment. She's renting the most amazing beachfront property. So it's an older unit. It's only a couple $100 a week, but you literally look out of her curtains and you're looking at the beach. It's amazing. It's on the Gold Coast, and it'd be hard to, that property that she's paying, $400-500 a week rent would be worth millions. And this is always the hard disparity where it's like, well, I can afford that as a rent, but if I want to buy it, I don't have the deposit for a few $1 million property. So this is coming back to the point, the champagne taste and the beer budget. It's hard to sort of consider it, but your first home is just that. It's your first home. It doesn't need to be a forever home. It doesn't need to be the home that you're going to raise your kids and retire in. It's a stepping stone. It's going to be getting you on the market. It might not be that beachfront property that you're watching the sunset and the waves roll in, but that's where you eventually can get to. So this home needs to be for the here and now.
And the other thing to keep in mind is it is that stepping stone, like you said. I've had clients that we've helped over the years. They purchased 4 years ago. They got in at a good time. The property's gone up. They've sold. And they can use that capital now with increased incomes to go and buy that next property that's going to be better suited because now they have a family. Things have changed. So do see it as a real stepping stone. If you're in an area like Sam in that situation where you might be on the Gold Coast or in a very specific suburb that you love and you really want to try and stay in that area, you might need to think twice because sometimes buying land where you're going to have that appreciation might be better for the long term versus getting a unit where they can keep multiplying them.
The other way you can run it is instead of buying your first home, and this is if you get your first home, there's lots of advantages which we're going to come back to on the deposit side, but you could look at rent vesting. If you're really, like Sam, for example, you say, I want to live on the beach. I never want to live at the beach, but I can't really afford the beach. You could say, well, you can keep renting, it's fine, and potentially look at buying an investment property somewhere else, in Brisbane, in Perth, seeing a lot of investors go there, Melbourne, etc. And you're still getting that property exposure, but you can keep living where you are.
Now, the downsides with rent vesting, as Jaden mentioned, and we'll run through some of the schemes available, but you wouldn't be eligible for any first homeowners grants, stamp duty concessions if you're under the thresholds. So you'd miss out on a few things there, and you'd also need a larger deposit. So definitely a good idea if you are worried about that. Otherwise, you can do the next suburb over. So we always talk about in that situation where Sam is in a very specific suburb, loves the beach environment. Maybe you go, well, this is going to be a little bit of short-term pain for some long-term gain. So I'm going to look at the next suburb over that might be cheaper, or I might look further inland that might be a bit cheaper. Remember, when you buy a home, a lot of the government requirements are that you live in the property as a first home within the first 6 months and you stay there for 12 months for the stamp duty concession. So you could always live in it to begin with and then move out and then do the rent vesting strategy by getting in with minimal deposit. You've got to be careful with some of the other government schemes like the home guarantee scheme. In that specific scheme, if you're not living in it, you actually have to refinance out of it once it becomes an investment property. So something to think about and really take into account what your future circumstances may be. But in a lot of cases, we've had clients that have thought of this as a stepping stone and then utilize their sales proceeds from their first home that increase the amount of cash they had because the capital increases to buy the next one. So Jaden, do you have anything else to add to that before we move into the next one around the deposit?
Yeah, I think also in that sort of strategy where there's a bit of a best of both worlds, one thing you can look at too if you sort of worry about the repayments, we mentioned it before, is when you're looking at buying a place, can you buy something that's potentially 2-bedroom? So instead of trying to get a 1-bedroom or a studio, is there a way you get a 2-bedroom, potentially when it's possible, depending on the grant and the schemes that you got, to rent it out to a friend, and then they can help pay for your mortgage effectively. So there can be some strategies there that you can try and think a bit out of the box to help you get into the market and help you pay off that loan quicker.
Yeah, I think you got to be careful here. I've had a client that has done this. They bought a property that was 2 levels, downstairs had a separate sort of residential area where there's a kitchenette, all that sort of stuff. They looked into it, talked to your solicitor, talked to your tax accountant, also look into the government schemes and grants. They had to live into the property for 12 months without receiving any rent, but then thereafter they could look at renting out downstairs and do it successfully, all above board. They went through, it was on their tax returns, everything like that. So there are things you can do. It might be that you move in, you live in it for 12 months, and then you look at those options once you pass the requirements for like the stamp duty waivers. Some of the schemes and grants don't allow that, so you'll have to look into it. Working with a broker like ourselves, we can run through the details and give you very specific advice.
So the next point we've got is you don't need a 20% deposit. So there's 2 different amounts you need for deposit if it's a home to live in or if it's a rent vesting scenario. So on the rent vesting, if you're looking at doing that, like Nathan said, you need a minimum of a 12% deposit, plus you've got to pay stamp duty. So there's no concessions if it's an investment, you've got to pay the full freight. But if it's your first home?
Well, that's exactly right. So like Jaden said, if it's investment, you need a larger deposit. If it's a first home, there's a home guarantee scheme. So this scheme is available for permanent residents and Australian citizens where you can put a 5% deposit and the government acts as your guarantor. So literally, you only need a 5% deposit. And if stamp duty is applicable, you need to cover stamp duty. So in a lot of cases, we have first homeowners talking to us saying, Nathan, don't I need a 20% deposit? The best news is, no, you don't. There's a lot of schemes and a lot of grants available nowadays, which covers a wide range of borrowers in being able to achieve that. With this scheme, there are some income requirements. There are some property price caps you need to be aware of. And that's where working with a broker like ourselves can help. We can run through what you might qualify for, what you might not qualify for.
Yeah, so the interesting thing where there's been some changes, actually some tweaks on this scheme over the last couple of months is it's also available to anyone that hasn't owned a property for 10 years. So you might have had a property 10 years ago, bust up with an ex, something like that, haven't owned a place for that, you're eligible for the same schemes, has the same requirements. The other thing that's changed recently is also the genuine savings. So previously, up until a couple of months ago, for that Nathan's 5% deposit, if you're buying a place for $500,000, you needed a $25,000 deposit that just sat in your account and did nothing for months. Now, you can actually get those funds gifted from your parents. Nathan's mum and dad say, here, mate, we're helping you out, $25,000, put in the account, and you don't need that requirement. So it's definitely helping people get into the market where you might be struggling with saving. You might have cases where people have given their parents money a couple of years ago and then it's sitting in the parents' account and the bank say, well, that's not Nathan's money, it's his mum and dad's, it's in his account. Well, they open it up. So some really good tweaks on this scheme, but probably the biggest downside and where you need to speak to your broker with planning is just that future planning piece. So this scheme is, the intention is to help you get into your first home, a home that you're going to live in longer term. If you're going to turn it to, say, an investment after 12 months and move out and turn to a landlord, this is where there can be problems. So I know you had another client that moved to Memphis that went overseas. They bought under the first home guarantee scheme, and after 12 months moved out. What happened there?
Exactly right. So the government does require that you refinance out of the scheme as soon as the property turns into an investment property. So you do need to be careful because you are lending up to 95% of the property. So in the future, when you go to move out of that scheme, we'll need to refinance you, value the property again, and make sure that you're lending hopefully under 80% of the property value so you don't have to pay mortgage insurance. You can still refinance at above 80% of the property value, but then there's mortgage insurance that might be applicable depending on your occupation, because some occupations you can get away. So I guess for first homeowners out there, we have seen the average age of first homeowners increasing in Australia to 36 recently. That's a real concern. And some of those concerns around affordability on repayments, we talked about strategies today around that, around the amount of deposit you need, we went through that, and buying your dream home, remembering it doesn't need to be your forever home. Guys, here at Hunter Galloway, we're a mortgage broker. We assist with home buyers right around Australia. If you need assistance, hit us up. We'd love to help. There's no cost for the service. You can call us on 1300 088 065 or visit our website huntergalloway.com.au, and we'll see you next time.